Hey everybody, this is Brent from Wolf on Wall Street Trade with the market update for the week ending September 20th, 2019. This was another really weird week. So if you look at things on the surface, it looks sort of like that. Everything's calm and peaceful and tranquil. But then you dig underneath the surface a little bit, look under the hood, and it's more like that. Coming into this week, for underlying influences, and those were an attack Sunday night on Saudi crude facilities that shut down half of their capacity, or took about 5 million barrels per day off the market. Next up was the dollar funding market just freezing up. And you can see that here with the overnight repo rate just absolutely skyrocketed. So this generally trades pretty close to the Fed funds rate. So let's say the Fed funds rate, like it just was before this week, is in the 2% to 2.25% corridor. Then the repo rate will generally be somewhere in between that, like 2.15%. Well, something broke this week. You can see it spiked up as high as 10% intraday on Tuesday. And we had quadruple witching Friday, the third Friday of the third quarter. And this was actually a really dominant theme in the market this week. And finally, the FOMC, the Federal Reserve, their policy meeting on Wednesday, and they cut rates by 25 basis points. A little bit of volatility there. So we ended last week with this loss of momentum candle, a potential reversal. Now that doesn't mean that it has to go down, but it means that this trend is losing momentum. So it moved from up to sideways. So let's take a look at the weekly candles. So here's the S&P, and it was down 0.5% on the week. You can see it over here. That is an inside week, inside last week's real body, which is another potential reversal signal. The Dow was down just over 1%, again, inside week. The NASDAQ 100 down 0.9%, and you can see by these long wicks on these candles that it's feeling resistance up here, and we'll take a look at that on some intraday charts. And small caps, or IWM, again, big week. Remember last week they really benefited from that rotation from growth style factor to value. This week, actually, that rotation corrected, so they were down 1.2%, and again, an inside week, losing upside momentum. You can see resistance here really clear at the top of these two candles, these upper wicks. The S&P 500, it was down 0.5% for the week. But if you look at it on daily chart, it actually entered Friday, it entered quadruple witching, pretty much flat on the week. So that 0.5% that it was down on the week, it was down on Friday. And that's pretty much the same story for the Dow Industrials and also the NASDAQ composite, or the NASDAQ 100 rather, down 1% on Friday alone. So pretty much all the losses that were made on the week were made on Friday, except in IWM's case. Those losses were earlier in the week, didn't lose so much on Friday, just down 0.2%. Point of interest, since last week I was talking about really unusual relative strength in a few areas. Volatility up 9% on Friday and up 11.5% on the week. And you might remember last week I talked about VVIX showing relative strength and small caps volatility gauge actually being stronger than they should, with VVIX holding this bullish consolidation trend, big up move, and so it's kind of like a flag. It's a bullish consolidation really, and it has held that. So in the hundreds, it's the reddish zone. Above 110, 115, it's a whole different scenario. You're going to be in a very ugly market at that point. And that relative strength and volatility on the week was despite this huge 15% crush of volatility on Wednesday. As soon as the FOMC ended, here's the FOMC at 2 o'clock, knee jerk, and just crushed it. And that really helped stocks accelerate off of Wednesday's intraday low after the FOMC policy statement came out. Before I forget, let me just mention there is a really clear zone of resistance in the S&P 500 up here around 3020 to 3021, and that comes off of this gap down from back here at the end of July, the 29th and the 30th of July. There's the gap. Here's where it's been hitting resistance. And by the way, this was the FOMC in July when they cut rates by 25 basis points the first time. Tariffs went up and all that other stuff, and we got this sell-off. 15-minute chart, you can see while it looks like nothing really happened other than resistance up here as we come into this week, actually a lot happened, and you have to look at the trends as they developed through the week. There were bull flags, or actually a bullish week, bullish consolidations, not just in the S&P 500, but in a lot of other places. This is the move up. This is the consolidation. It started the week over here, continuing a bull flag, and had this bull flag had a nice clean breakout, the upside target would be about 3050 for the S&P 500, but that's not what happened. So I'm going to zoom in this chart a little bit, go down to a lower time frame, let's say 5 minute. So here's coming into this week, continuing this big bull flag. Remember, I was just showing you that. There it is. This is how we came into the week. So started the week with a very bullish look to it. S&P sectors had the same look, many of them, different averages, IWM, same thing. The first 3 days of the week, nothing was happening. The market was just trending in this really shallow trend. Here's the FOMC, the initial knee-jerk reaction. It was actually kind of up, down, up, down, up, down, down, up. This was the strongest point on 3C charts in the week. Just after 2 p.m., I sent out a note to members and said, wow, there's a positive divergence here. They're buying this decline as it was kind of churning around in here. And a few minutes later, maybe 10, 15 minutes later, we got this move. And this speaks to the fractal nature of markets. And the concepts are all the same. So once you kind of learn the price pattern, you can apply it to whatever time frame that you trade in. I look at all these time frames. So here it is, big bull flag, a small bull flag within this big bull flag. And then on Thursday and Friday over here, an even smaller bull flag within this bull flag that's within this bull flag. The whole thing reminds me of those Russian Matryoshka dolls. You know, remember these things, kind of one fits in the other. So looking at it from this perspective on a 15-minute chart, hit resistance here on that 30-20, 30-21, consolidated. That's fine. But when you get a breakout like this, it should break out. So the fact that it hit that resistance again and consolidated again in another little bull flag kind of took some of the shine off the bullishness of this. And then on Thursday, Friday, this other smaller bull flag, which completely failed. Here's a closer look at it. So this is Thursday, here's Friday, consolidation, and then did not break out, but failed. This concept applies to the bigger flag. And the concept is this: when you have a bullish pattern like this bull flag, and it breaks out, it should really break out. It should not be hitting resistance here and turning back down. So like I said, that took some of the shine off of it. And the danger that this creates is you get a failed breakout. Those often lead to fast reversal. Here's an example of that concept. Remember IWM, small caps from July, trading in this range, tried to break out over here. And I'll just walk this forward real quick. There's the breakout attempt. Failed breakout, fast reversal. The best looking chart as of the end of the week is still small caps. So here is their flag. Again, an attempt to break out that didn't go anywhere, but pretty much still holding this flag. And this 155, 156 area is pretty key for IWM. I'll show you why. This is the August downtrend. This is the breakout where small caps really got a big boost last week. Here is the flag, and that flag is right here at this important trend. And confirming this whole consolidation was Treasuries. Here is that spike in yields as the stock market rallied. Here is a consolidation. It's like a little bull flag. At the end of this video, when I wrap everything up, I'm going to touch on this because this is a very important thing to watch. It is consolidating like the major averages, but they too had a failure to launch this week. The 11 S&P sectors reveal a little bit more of the character for the week. So if we look at the best performing sectors, there were only 4 of 11 that were up, but the best performing of them were defensive. So XLU, utilities, still holding this uptrend, and in fact, made a new all-time high on Thursday. While not making a new all-time record high, the real estate sector was up 1.4% on the week, just behind utilities at 1.5%. And then rounding out the top 3 was the defensive-oriented healthcare. You can see it did try to break out of that flag. Same kind of consolidation. A lot of S&P sectors look like this coming into the week. Pop back to weekly charts here for the other ones. The worst performing sectors on the week were all cyclicals. So industrials down almost 2% here. Inside day, big ugly candle. Transports were one of the best performing areas last week because they were part of that value rotation. This week down 3.32%. Inside week and a big ugly candle. The communication sector down 2.5% on the week. This is kind of a classic reversal. Strong upside momentum, loss of momentum, reversal. Regional banks were also a big performer last week because of that rotation into the most beaten up stocks. One of the worst performers this week, down about 2.4%. Semiconductors also down 2.4%. So what you get out of that is the best performing sectors were all defensive. Utilities, real estate, and defensively oriented healthcare. The worst performing were all cyclical. There may have been a little influence from that rotation last week, corrected a little bit this week. Remember last week it was a style factor rotation out of momentum into value, out of what had been working into what was beaten up and low priced. Well, that corrected a little bit this week. Here they are normalized as of Monday's open, and what you might notice is that momentum gained a little bit and value kind of pulled back. So just a little bit of a correction of last week's monster theme, and that's reflected in the weaker performance this week of transports, retail, regional banks, stuff like that, that really did well last week. Let's take a look at the 3C charts real quick, and what you'll probably see is the same kind of theme that some of the other averages didn't look as good as far as that kind of bullish consolidation, and IWM still has it. It looks a little bit better. That was the theme on 3C this week as well. So here's the 1 minute chart. Small caps IWM have looked at the best on this whole run until last week we started getting this negative divergence. So this is kind of along the lines of what I might expect to see when you transition from a strong uptrend to now money is starting to slow down and not flowing, and you go into a consolidation. On Wednesday, just after 2 p.m., I sent out that note. I said there's a positive divergence in both SPY and IWM, and we got this move up. There's the positive divergence right into the FOMC low. So this happened as the market was selling off. In my opinion, small caps still look the best of the major averages. Let's take a look at SPY. And you can see what I mean looking at SPY. Way different chart. Okay, so it did not confirm any of last week and then didn't confirm any of this week. The positive divergence that I was talking about is right there, very small. This is exactly what it looked like at the time. There's the FOMC knee jerking up and down and selling off here. Positive divergence, 3C making higher lows. And that led to the rest of this on Friday. And on the longer term trend charts, it's kind of the same thing. So here's July, 3C not confirming the record highs in the S&P. Got this sell-off. Here it is, not really doing much through this consolidation. So a little bit of improvement. You can see that positive divergence at the FOMC right here. So it looks a little bit better, but still not confirming. And IWM looks the best. Here is that failed breakout July where 3C didn't move up and confirm the range here. And this week it has added to that, so it's starting to confirm a little bit better. But what you have to remember is that small caps really got a huge benefit from not only that move or that rotation from momentum into value, but they also had a huge short squeeze, which was the largest in 3 years. So I tend to look at the market in terms of the S&P as a benchmark, because we saw last week small caps outperformed and NASDAQ underperformed, because each of them has a heavy influence in one of those two style factors, IWM in value and NASDAQ in growth and momentum. The S&P is more diversified in every way, including those style factors. Quickly touching on those 4 main themes. First, the repo rate chaos. It didn't have any effect on the market whatsoever. This really was a big deal. I mean, it prompted the New York Fed to conduct 4 repurchase operations this week, and that was the first time in a decade that they've done this. I think the first one was 50 billion, 75 billion, 75 billion, 75 billion. All of them were oversubscribed. So these primary dealers wanted more money than they could get out, which is why these repo rates exploded higher in the first place. Fed announced that they are going to keep doing this $75 billion repo every single day through, I think it was October 10th or something. So they're worried about liquidity in the market, trying to make sure it's all there for the quarter end. Whether it's big trouble for stocks or not, it's one of those things. It's like when you have a Lehman moment and something collapses, people will point to this, but in real time, nobody really cares. In the stock market anyway. I'll just say it's bad optics to have the Fed conducting emergency anything every single day of the week. At the FOMC meeting on Wednesday, the Fed cut by 25 basis points, pretty much what the market expected and had priced in. Reactions were very interesting. The dollar reacted, moving up, gold down, the 10-year yield up, and yield curves got flattened like a pancake. Every single one of those assets had a bearish or hawkish reaction to the Fed, meaning disappointed. If the Fed had impressed the market and the market was happy with it, you would have seen the dollar down, you would have seen gold up, you would have seen Treasury yields down, and yield curves would have steepened. All the opposite happened. And here's the S&P 500, initially down, reacting like all those other assets, not happy with it, and then back up. So that's the whole knee-jerk, but the takeaway is that most asset classes reflected disappointment or a hawkish Federal Reserve rate cut or even a policy mistake, but stocks ended up rallying. I think part of that reaction in stocks to the FOMC, kind of doing the opposite of all the other asset classes, had a lot to do with quad witching. If you look at a 5-minute chart of the S&P 500 on the week and you look at the 3,000 level, boy, it sure seems like there was a quad witching influence. I think there was something like $8.5 or $8.6 billion at the 3,000 strike going into Friday's expiration. Gold, let me touch on it briefly. Here is a daily chart of gold's trend. Doesn't look too bad. Here are my trend lines. So we have 2 trends here from June and from late May. And if we zoom in a little closer, you can see that gold has just been trading around the bottom of that channel For 3 weeks, I've been saying that we've seen 3C buying around 1500. So every time gold futures would come down to the 1500 level, a positive divergence would show some buying. So it's still holding around there, moved up Friday on a risk off or safe haven inflow. Coming into the week, the big news was the attack on Saudi's oil facilities. The result of that attack took half of Saudi's crude oil production offline. That was about 5 million barrels a day. So we expected crude to open big on Sunday. It did. I'm using USO here just because I can't pull up my futures chart at the moment. Here's Monday's open. It spiked up as much as 15% on Monday. That is the biggest intraday spike since crude futures have traded in their history. And since I don't have the futures, I'm just going to show you on USO. Crude has been trading since really all through August and hitting this resistance range in 57 to 58. I have that as 1220 here on USO. So here's the open this week, and here's what happened after that. Take a good look at that. I'll even go to a 15-minute chart. What does that look like to you? I'll add some trend lines there. It looks like a bear flag. How is this possible that half of Saudi's production can go offline? You have a war premium now with Iran in the hot seat, and crude is trading back at that 57, 58 level. I mean, what does it take to move crude? So if this flag, which, it's not a perfect flag, but they never are, if that breaks, I'm just going to give you a rough measured move. That's roughly almost 8% down. And it is consolidating right at that key level. So this is going to be very important to watch next week. I'm just shocked that crude is back here after all that. And let me touch on currencies real quick. There's 3 pairs that I've been keeping a very close eye on: the Aussie dollar, the dollar yen, and the dollar yuan, Chinese yuan, offshore yuan. You might remember this range in August, keeping a very close eye because currencies tend to lead stocks. That happened over here. The Aussie led the market lower a week ahead of time. So this is the move above the range as of last week's close. And then as we came into this week, it started to break this uptrend, which is fine. I mean, it can consolidate too. It should consolidate with the major averages consolidating, but it got worse than that. So the Aussie dollar fell back into that range. So here's how we ended the week. A move down, a consolidation, and I have a lower measured move down here. And this is a commodity currency. It's very sensitive to the Asia Pacific region. It's very sensitive to China. And what happened this week with China? The worst industrial production print in 17 and a half years. Dollar yen pair had broken out. We're trending up with stocks broken out of this August range. This is actually a reaction to that attack on Saudi Arabia and their crude oil supply. So that is a safe haven move, the yen getting bid up. And the rest of the week it kind of just drifted in this consolidation. Here's how we ended going into Friday. This is a bearish descending triangle. The key area to be paying attention to is this range. So the Aussie dollar is already back in this range. Here is the dollar versus the Chinese offshore yuan. So it's been consolidating. Let's zoom in. I know this is a lot of trend lines, but let me zoom in. So to keep things nice and simple, when this goes up, it's usually risk off for stocks. It's usually in reaction to some trade war dynamic. This was a risk supportive trend the last 2 weeks. This pair moving down. And here it is. So while stocks were rallying, this was trending down. This is coming into this week. Consolidation, right? It's just consolidation. Well, maybe not. The 713 level is what I've been talking about for many, many weeks. If this moves above 713, that is a major escalation in risk. And Friday, the pair closed right there under that 713 level. This was news on Friday. The Chinese trade delegation had been in Washington, so they were starting like mid-level preliminary talks. They went back early, so the market heard this and flipped out, of course, because it looks like the early mid-level negotiations aren't going well. So this is what you're seeing, an escalation in risk. That's why I keep talking about the 713 level. So heading into next week, ugly closes for the averages on Friday. There's the S&P 500. The Dow closed at the low of the day over here. NASDAQ, again, ugly close on Friday. Small caps a little bit better, and they still have more a bullish flag over here. Here's an intraday chart, the S&P 500, the 530 yield curve. That is that turn I'm talking about. This looks kind of similar. That is this move over here in the Aussie dollar. So what I think is key going into next week is what does crude do around that 57, 58 level? Because if it moves higher, it can help the stock market in the short term. It will not help the economy in the long term if gasoline prices and crude prices are digging into consumer spending. More importantly is what are yields going to do, Treasury yields. They didn't make a big move on Friday, about 2 basis points down with the S&P. So do they keep that consolidation and continue higher? in that case would be supportive for stocks? Or does this consolidation fail and they move lower, in which case that would be another risk off or flight to safety scenario, and or growth expectations moving down. Remember the industrial print in China, worst in 17 years. If the S&P can actually break out here above this consolidation, above this resistance, fill that gap, break out, then I think it has a measured move up to 30.50, and that brings us right to that broadening top that we have been seeing since January of 2018. In my opinion, the risk reward for being along the S&P here is meh. You have to be patient with this kind of market. Now we're seeing some of those macro signals in terms of the yield curve, in terms of currencies, but I really do want to see what happens with bond yields. I think bond yields turning down would be a trigger to go ahead and sell this market. Okay, so that's going to do it. Thank you for watching. If you liked the video, please give it a thumbs up. Feel free to leave comments, questions in the comments below. There is a subscribe link down here at the right lower hand corner, and you can always go to the website. I do post some free content. And you can follow me on Twitter. Thanks a lot, everybody. Have a fantastic weekend.